Most people think the crisis began in 2008. It didn't. The fractures started years earlier, rooted in the boom that followed the dot-com bust. After the dot-com bubble burst in 2000, markets collapsed, investor confidence faltered, and the economy slowed. Webvan, eToys, and Pets.com all went bankrupt. Even big players like Cisco and Intel lost over 80% of their value. The Nasdaq dropped 78%, wiping out trillions. By early 2001, the US was officially in a recession. The Federal Reserve responded by cutting interest rates deeply. The federal funds rate went from over 6% in 2000 to about 1% by 2003. Cheap money encouraged borrowing, especially for housing. With interest rates near historic lows, saving offered almost no return. Bank deposits earned next to nothing, so financial players chased the next big yield, housing. Mortgage originations exploded, leverage increased, and Wall Street's biggest firms were ready to package this into investment products. Between 2000 and 2006, U.S. home prices rose by over 80% nationwide, even as interest rates began to climb in 2004. Why? Because credit was still easy, speculation was rampant, and everyone believed prices would just keep going up. In some neighborhoods, house prices didn't just rise, they sprinted. A home bought one year was worth tens of thousands more the next. People didn't feel rich because they earned more. They felt rich because the house did. Owning a home stopped feeling like stability. It started feeling like a shortcut. And everywhere you looked, the message was the same. Buy now. Don't miss out. Renting was framed as failure. Owning was framed as responsibility. Mortgage ads, billboards, seminars in hotel ballrooms. The message wasn't subtle. If you weren't buying, you were falling behind. Banks stopped offering safe 30-year fixed mortgages. Instead, they pushed 2/28 ARMs, low rates for 2 years, then a payment spike, no doc loans, no proof of income, ninja loans, no income, no job, no assets. These were given to almost anyone. If you could fog a mirror, you got a mortgage. Why? Because the banks didn't plan to keep them. They bundled the loans and sold them off. Risk removed, or so they thought. Individual mortgages were pooled into mortgage-backed securities. Your neighbor's mortgage in Florida, Nevada, or Arizona became part of a bond sold worldwide. Banks collected fees and got the risk off their books. But risk didn't disappear. It was simply transferred to investors in Europe, Asia, and pension funds everywhere. Collateralized debt obligations, CDOS, slicing mortgage pools into tranches, AAA, supposedly safest, BBB, mid-risk, equity tranches, first to take losses. The same risky mortgages kept getting repackaged, but with fancier labels. Rating agencies like Moody's and S&P gave top scores to chunks of these structured products, convincing investors they were safe. But while the product was loaded with bad mortgages, the people buying it didn't know. They trusted the AAA ratings and believed the U.S. housing market could never collapse. The AAA labels weren't accidents. They were incentives. Rating agencies were paid by the very banks issuing the products. If you gave low ratings, banks took their business elsewhere. If you gave high ratings, everyone got paid. They still exist today because the system depends on them. Investors need shortcuts, regulators need benchmarks, and markets still prefer a clean label, even when the risk is anything but. Some people on Wall Street did see the cracks. They warned about the loans, about the leverage, about the assumptions that could never be tested until they were. But calling it out meant risking your career. When everyone around you is making money, skepticism sounds like incompetence, so most stayed quiet, and the machine kept moving. By 2006, US home prices stopped climbing and started falling. Subprime loans began resetting to higher rates. Defaults rose sharply. Foreclosures surged. Suddenly, those AAA-rated bonds were exposed as dangerous. Banks looked at other banks and wondered, who else is underwater? Trust evaporated. After the Great Depression, traditional banks were heavily regulated, but over time, a parallel system grew outside those rules. Investment banks, hedge funds, and money market funds began doing bank-like things, borrowing short-term, lending long-term, using leverage. They looked like banks, they acted like banks, but they didn't have the same safety nets. When the crisis hit, this shadow system had no protection, and when it broke instantly. In 2004, regulators quietly changed the rules. Investment banks were allowed to take on far more leverage. For every dollar they had, they could now borrow 20, 30, even more. As long as prices went up, leverage amplified profits. But when prices fell, leverage amplified destruction. Small losses suddenly became existential. On September 15, 2008, Lehman Brothers filed the largest bankruptcy in U.S. history. Markets plunged. Credit markets froze. When Lehman Brothers collapsed, it wasn't just another bank. It was a symbol. A 158-year-old institution, gone overnight. If Lehman could fail, anyone could. Even money market funds, usually the safest place to park cash, started losing value. That had never happened before. It sent shockwaves through the global financial system. This wasn't just a housing crash anymore. It was a full-blown financial meltdown. For employees, it was brutal. You showed up to work like any other day. By afternoon, security was escorting people out. Careers vanished. Retirement accounts tied to company stock were wiped out in hours. Several major institutions were bailed out as they teetered on the edge, including AIG, then the sponsor of Manchester United, as well as Fannie Mae and Freddie Mac, the two massive government-backed mortgage lenders. The U.S. Treasury authorized $700 billion for TARP, the Troubled Asset Relief Program, to buy troubled assets and recapitalize banks. The Federal Reserve did even more, creating emergency lending backstops and swelling its balance sheet by trillions. Without these interventions, the global credit system might have collapsed entirely. But the cost was real. Millions of jobs were lost. Millions of homes were foreclosed. In 2007 and 2010, about 8.7 million jobs were lost in the United States. Unemployment hit 10% at its peak. Net worth fell trillions of dollars. Yet the executives who helped create the system stayed free. Some banks paid fines. Many executives kept their wealth. The crisis ended, but the behaviors that caused it largely didn't.